Let's settle this right now. Gold versus silver in 2026. Which one actually makes you money? Because both metals have been on an insane run. Both have made investors serious money. Both are sitting at price levels that would have seemed absolutely delusional just 2 years ago. But here's what most people get wrong. They are not the same animal. They behave completely differently. They respond to different forces. And right now, in April 2026, the battle between these two metals is more explosive, more unpredictable, and more fascinating than it has ever been. So we're breaking it all down today with real data, fresh numbers, and zero fluff. Let's go. First, where do things actually stand right now? Gold is trading around 4,813 per ounce. Silver has been in the $70 to $75 range this week, having surged more than 140% from the start of 2025. Now, before you say, well, gold is obviously more valuable, pause on that percentage. Gold made investors roughly 70% in 2025. Silver made investors 140% in the same period. That is double the return. On pure performance, silver absolutely demolished gold over the last 12 months. But here's the twist that makes today's video so important. On April 2nd, 2026, silver just got crushed, down 4.5% in a single session. A stronger US dollar and shifting Federal Reserve interest rate expectations triggered the sell-off, blowing the ascending trend line that had supported silver's recovery from March's lows completely out of the water. So the question everyone is asking right now is that the beginning of something worse? Or is today's dip the buying opportunity of the year? We're going to answer that. But first, you need to understand why these two metals are fundamentally different, because this is where most investors go completely wrong. About 90% of gold demand comes from investment, central bank reserves, and jewelry. Industrial applications exist, but they're a small slice of the pie. Gold's value is almost entirely built on one thing: its role as money and a store of wealth, a role it has played for 5,000 years without interruption. No technology disrupts that. No quarterly earnings report changes it. Gold is the ultimate financial anchor, and that is what makes it behave the way it does. Silver is a completely different beast. About 60% of annual silver consumption is tied to electronics, solar panels, and semiconductors. Electronics alone account for roughly 445 million ounces of silver demand every single year, making it the single largest industrial use of the metal. Think about what that means. Every smartphone, every EV battery, every solar panel, every AI data center being built right now, they all require silver. Silver isn't just a precious metal. It is a critical industrial material that also happens to function as a monetary asset. That dual identity is silver's greatest strength and, simultaneously, its greatest source of wild, nerve-shredding volatility. Now let's talk about the gold-to-silver ratio, because if you are trying to decide between these two metals right now, this is the single most important number you need to understand. The ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Today, that number sits at around 63 to 1. Back in early 2025, it stood at 104 to 1, meaning silver was dramatically, historically cheap relative to gold. Since then, it has compressed to roughly 64 to 1, which tells you silver has been gathering momentum fast, gaining ground on gold at a serious pace. Over the past century, this ratio has ranged from roughly 15 to 1 all the way to over 120 to 1, with the long-term average hovering right around 60 to 65 to 1. And that's exactly where we sit today, almost perfectly at the historical average. What that means is silver is no longer screaming cheap relative to gold, but it also hasn't overshot to the point of being overvalued. We are in neutral territory on the ratio, which makes the next leg of this story completely dependent on macro conditions and structural fundamentals. And that is where things get genuinely interesting. On the macro side, the picture is complicated right now, and you need to understand both sides of it. On the bullish side for metals broadly, you've got geopolitical tensions that aren't going anywhere, persistent inflation concerns, deep uncertainty around U.S. trade and tariff policy, and serious questions about the Federal Reserve's independence. These forces all lift gold, and when gold moves with real conviction, silver follows and then overshoots. That has been the pattern in every major precious metals bull market in history. But on the other side, today's reality is working against silver specifically. A stronger dollar, a market repricing interest rate expectations in a hawkish direction. These are headwinds. And silver's hybrid industrial monetary nature means it is caught in the middle right now. Short-term liquidity pressures are overshadowing the long-term demand story. Gold, being more purely a safe haven monetary asset, handles Federal Reserve hawkishness better than silver does. When economic growth slows or uncertainty spikes around rates, silver's industrial demand story gets complicated fast. That's just the honest reality. And it's exactly why silver dropped 4.5% today while gold held up far more gracefully. But here is the structural story that most retail investors completely overlook, and honestly, it might be the most important thing in this entire video. Silver is heading into what the Silver Institute is calling a sixth consecutive year of supply deficit. Let that land for a second. 6 consecutive years. The cumulative supply shortfall from 2021 to 2025 has been approaching 800 million ounces. That is 25,000 tons of silver that the world has consumed beyond what miners have been able to dig out of the ground. And that gap isn't narrowing, it's persisting. Global ETP holdings are sitting at an estimated 1.31 billion ounces. The London market has been experiencing tight physical supply conditions. The fundamentals on paper are screaming bullish. And yet silver drops 4.5% in a day. That gap between the physical reality and the short-term price action is the entire silver story in 2026. It's frustrating if you're holding it right now, but it is also what creates the explosive upside potential when sentiment flips and the macro winds shift direction. Now let's talk risk profiles, because this is where you really need to be honest with yourself before you put a single dollar into either metal. Precious metals analyst Jeff Clark put it perfectly: silver is a jet ski compared to gold's cargo ship. In percentage terms, silver tends to move roughly 1.5 to 2 times as much as gold on any given day. That means it offers greater upside during bull markets, but it also means steeper, more brutal drawdowns during corrections. We are living that right now. Gold pulled back from its highs with composure. Silver got hammered. If you are a conservative investor, if a 4 or 5% single session swing makes you want to sell everything, gold is your metal, full stop. Gold performs better in recessions and market crashes. It holds its value when things get choppy. Central banks are buying it. Major institutions are holding it. It is the cargo ship, steady, deliberate, and it will not give you a heart attack on a Tuesday afternoon. But if you want the potential for superior percentage returns, if you have the stomach for volatility, if you understand that the structural supply deficit is real, silver has an extraordinarily compelling case. Because yes, silver fell 4.5% today, but silver also rallied 140% in 12 months. Gold did not do that. Silver doesn't make money slowly. It makes money explosively in concentrated bursts, and then it corrects, sometimes hard, and then it explodes again. That has been the pattern in the early 1980s, in 2010 and 2011, and again through 2025. So where do prices go from here? On the gold side, the picture is relatively clear. Goldman Sachs has a $5,400 per ounce target. Bank of America and HSBC are targeting up to $5,000. Deutsche Bank sits at $4,250. The consensus across major institutions is that gold remains in a bull market, underpinned by central bank buying and safe haven demand. There is no major bank calling for a gold collapse. The argument is about how far it goes, not whether the bull market continues. For silver, the range of opinions is wider and far more interesting. JP Morgan analysts project an $81 per ounce average for 2026, though they're warning that near-term moves are going to be heavily dependent on Fed signaling. CME futures traders are pricing in a year-end average closer to $91. More bullish analysts see $100 or above as possible if the structural deficit tightens physical supply enough to force the market's hand. On the downside, if the key $67.35 support level fails, we could see silver test the $65 zone. Major support sits at $69 to $70 per ounce. Resistance is at $82 to $84. Right now, silver is sitting right on the edge of that support window. The next 2 to 3 weeks are genuinely critical, and there is one more wild card that is not getting nearly enough attention: tariff policy. The U.S. market is net import dependent on silver. Any revival of Section 232 tariffs on critical minerals could dramatically tighten physical liquidity outside the U.S. and create a powerful new upside catalyst. That investigation is still open. The 180-day negotiation window between the U.S. and its trading partners on critical minerals is actively running. If those talks break down, silver could react to the upside in a way that catches a lot of people completely off guard. So which metal wins? The honest answer is, it depends entirely on who you are as an investor. If you want lower volatility, central bank-backed demand, and a metal that acts as genuine insurance during a market crisis, gold wins. It's the cargo ship. It moves deliberately, it holds its value through chaos, and it lets you sleep at night. But if you want the potential for superior percentage returns, if you believe in the AI infrastructure build-out, the EV revolution, the clean energy transition, all of which require silver at massive industrial scale, and if you can handle the volatility that comes with that thesis, Silver has a case that is genuinely hard to argue with. For gold to repeat silver's 2025 performance, it would need to reach $7,000 per ounce. For silver to repeat it, it would need to reach 80 cents. Which one sounds more plausible to you? Today's 4.5% drop is painful if you're holding silver. But if you believe the $67 support holds, and the Fed eventually pivots, and the deficit story plays out the way the fundamentals suggest it should, today might be exactly the kind of dip that long-term silver investors look back on and wish they had bought more aggressively. Watch that 60-cent-35 level closely. If it holds, silver's next move is likely back towards $75 and then the $81 to $82 resistance zone. If it breaks, brace for deeper volatility and don't say nobody warned you. The metals market in 2026 is not for the faint-hearted, but for those who understand the game, who understand the fundamentals, who know the difference between short-term noise and long-term structure. There has rarely been a more fascinating, more potentially rewarding time to be paying close attention.